Hey everyone, Brian Bogner and Greg Towner here with Parallel Portfolios. Going to take the next few minutes, talk to you about the economy, talk about the markets. Of course, there's a lot going on right now, so let's go ahead and get started.
Yeah, thanks, Brian. Well, of course, we always like to start off taking a look at stock market price trends, and particularly important to do so this time around. Ever since we've been doing these videos, we talk about how the price trend has been up and everything's looking great. Well, with the damage that's occurred this last month, we pointed out in our monthly viewpoint earlier this month that our trend model has actually gone neutral now. So we've seen some damage. We've broken below the 200-day moving average. When we look at this, we're looking at kind of an intermediate term, maybe call it 6 months, somewhere in that area. A lot of these corrections can happen over time, not just price, but it is noteworthy. It makes us be even more selective about what we choose to buy. We're comfortable holding some cash during these periods when our trend model is neutral, just making sure we're owning quality and adhering to our risk discipline. One of the, there's a lot of factors that go into our trend model, but one of the reasons it's not outright negative and it's more neutral is this longer term look. This is a 10-year weekly chart of the S&P 500. You can still see it's well within its healthy longer term uptrend. Certainly it could come down a good amount more and still be within that trend. That decline won't feel good. We understand that. But it's just the difference of time framing, money that you would need for the very longer term versus more intermediate term. And it also depends on the type of assets and the timing that you're investing them in.
Well, I think that's a good point, Greg, because we do preach long term. Take a longer view, and the reality is, the S&P right here, 2756. But it could drop another 400 points and still be in this longer term uptrend. So we want to take a longer view and make sure we're not overreacting to things right here, just here in the short term. We've got volatility here, which we're going to talk about here in a few minutes. But I think that's a good point for folks to know. Let's switch over here to the emerging markets. We talk a lot about international. 2017 was a great year for emerging markets. Had a big run up here beginning of this year, and then it's just been downward. Developed markets, we don't have a chart today, but it would be not as down as the emerging markets, but it would still be going down. But here's the thing that looks very interesting is when we run a relative comparison of emerging markets to the United States, what we're starting to see is a little bit of a turn here. So while the United States is experiences volatility, some of these other markets could be firming up. Still a little too early to tell, but that is a positive nonetheless. This chart here has been a bit mind-boggling. Just a month ago when we did this call, oil looked great. It was a really nice uptrend, and literally in a month, we have had a massive drop in oil prices, which as you're going to the gas pump, that's a great thing. If you're invested in a lot of oil or energy, maybe not so. But what we analyze this and look at it to say, okay, is this just there's just a lot of oversupply right now and some geopolitical things going on that's driving prices down? Or could this be the canary in the coal mine telling us, well, maybe the global economy is starting to slow down a little bit, and this is maybe the initial thing? Again, it's still a little too early to tell, but those are the two things that we are monitoring very closely here when it comes to oil and energy prices. Oh, so last thing here for me, and I'm going to turn it back over to Greg. One of the things that we do look at is our growth versus value. Okay, so this is simply a ratio of growth stocks in the numerator and value stocks in the denominator. When the line's going up, growth stocks are outperforming. When the line's going down, value stocks are outperforming. And why is this important? Well, because you think about growth stocks, right? These are your Facebooks and Amazons and Netflixes and all those high growth companies that everybody's been wanting to own. When you think of value stocks, it gets real boring, right? These are financials and some of your more value oriented names that tend to just kind of plod along. Well, sure enough, last 2 years, what do we have? Huge outperformance in growth versus value. Well, in this volatility, that is certainly beginning to change. And we've recently, in some of our allocations, have shifted away from an overweight in growth and moved some more to the value side. So we're taking a good hard look at this as well. All right, Greg.
All right, so when we think about, okay, so what would cause us to put some of our excess cash to work other than finding some really unique individual idea? Well, of course, our trend model getting more positive again, but also sentiment getting more negative. We talk a lot about sentiment. So the black line on this chart is a very long-term chart of the S&P 500, and the red kind of squiggly line there is a sentiment indicator that we look at. When it's at the higher end, investors tend to be more bullish. When it's at the lower end, they tend to be more bearish. And if you notice, when major market low points tend to happen when investors are quite bearish. Now, that doesn't mean we have to get all the way down there. Those are major market lows. But we have a higher degree of confidence when we do see more investors bearish, and it gives us a little more confidence in putting cash to work. So we're looking at trend, we're looking at sentiment, and of course a lot of other indicators, but those are two big ones that we're looking at here in the short to intermediate term to see how they play out. So investors want to know, what has been happening to this market. Of course, we could talk about the trade wars, and that is certainly very notable. But one other thing that's maybe getting a little less attention is what the central banks are doing. Our Fed here in the U.S. and their peers throughout the world. Of course, they had quantitative easing for years after the financial crisis, providing a lot of liquidity to investors, interest rates low, able to buy risk assets. Now we're seeing that quantitative easing decrease, and the liquidity is starting to go away, and it's projected to be even less in the years ahead. So you hear a lot of talk, even in kind of mainstream media, about what is the Fed going to do? Are they going to keep raising rates as the economy slows? That's a big question. If the Fed is raising rates because the economy is strong, that's okay. But if they're doing it and the economy is slowing and they're not realizing it, and then liquidity is drying up, that's a headwind. And so we think that's one factor that the market is factoring in here in this recent correction, among certainly some other things as well. Certainly not all bad. Small business optimism remains strong. This is the small businesses and what they're saying about what they're seeing. Anecdotally, we are hearing more and more concerns about trade war and what does that mean. That can change on a dime. The U.S. and China could get a plan any day now, and things get better, or it could drag on. No one knows for sure. But there's certainly a lot of good things still happening out there. And this is a survey that we're going to keep watching to see if it holds up. But for the time being, still some reasons to be optimistic on the economy. Tight job market and earnings are still solid. This is an important thing. We try to remind you about volatility. Of course, last year in 2017, very low volatility. The green is 1% up days in the market. The red is 1% down days. Last year saw almost none. The market just kept climbing higher like a high-yielding savings account. Just every month it went up for you. Now this year, it probably feels extremely volatile to investors, but it's really quite a normal year. In fact, much less than coming out of the financial crisis. So we're back to more normal volatility. It never feels good, but in order to gain the long-term returns that stocks tend to provide, that's the kind of the cost of doing business, unfortunately.
Yeah, and I think this ties back into what you were mentioning earlier about the Fed balance sheet. Just going back a couple slides, how on these central banks, they're really contracting. Because if you really think about the market and the economy going back to the low, coming out of the Great Recession here in 2009, you had these massive tailwinds, right? All kinds of money being pumped in from these central banks. And, just a lot of things being done that was creating, again, a lot of tailwind for the market. And then probably culminating here this past year in the tax cuts here in the United States. So we have been, very spoiled and in many ways very complacent, I think, here. And so, when we get back to some of this normalcy of volatility and things like that, it's not a new normal. It really is the old normal that we've got to get used to again. So in summary, the intermediate trend in stocks is broken. We've moved neutral in our trend model, but as we said, the long-term trend is still intact. Emerging markets may have found a relative bottom, which certainly from a valuation standpoint, they're a lot more attractive than here in the U.S. So we're looking at that. Will the Fed keep raising rates? As things start slowing down, the Fed has been raising rates and contracting their balance sheet much quicker than the rest of the world. So the rest of the world's kind of catching up to this. So what's going to happen here if things are really slowing down? It's still too early to tell, but I think that's the main question we keep looking at. But I think the most important thing for investors, if you're watching this, is that volatility is back and it's normal. Stock markets go up and correct, go up and correct. That is how it has happened since the beginning of time. And we've just been spoiled here these past few years where we've not really experienced a lot of that volatility or correction. So that's coming back. That's normal there. So again, if you guys have any questions at all, by all means, you know where to reach us. You know how to get us. Thanks so much for tuning in today, and have a great day.